rental yield and price growth trends impact return on investment, or ROI? Now, the relationship between capital growth and yield is very interesting. I think I would like to first talk about that. Now, we all know what the yield equation is. The yield equation is typical price, or the current price of the property, median rent or the weekly rent times 52 divided by 100. Yeah, 52, I mean 52 weeks in a year. And by saying 52, I'm not allowing for vacancies. So some people actually allow for 2 weeks vacancies, and they go time, and they actually do price times rent times 50 divided by 100 to get the yield. Now, because the price and rent are combined into the same equation, the increase in yield inadvertently means price growth stagnation. So when we see yield increasing in a particular suburb, that means that rental properties are more in demand than purchasing of properties. Sorry, let me rephrase that. That means the rental properties are more in demand, and that means that there's diminished levels of purchasing when it comes to trying to own a property. So we have a cohort trying to own a property and purchase a property, and we have another cohort of trying to rent. If the demand for rentals is outpacing the demand for purchasing, we usually see an increase in rents, and increase in rents lead to increases in yield. Therefore, increases in yield can inadvertently be used as a proxy for capital growth stagnation in property values, because not the entire purchasing cohort is not focusing on purchasing itself, but some of it is being diverted towards renting an asset. So this is very important to understand when we're trying to invest in balanced strategies. I usually direct our users on HTAG to answering, as I mentioned before, question number 5. What is question number 5? Are you in the acquisition or the expansion phase of building your portfolio, or are you in the consolidation? The acquisition or expansion means that we are accumulating assets in our portfolio. In order for us to build a substantial asset base, we actually need to leverage the growth from assets that we purchased into additional purchases. So while we are accumulating, our primary investment domain is capital growth. Now, this doesn't mean that we should manage our cash flow, because in order for us to actually be able to borrow, we need to maintain and sustain the properties that we actually own, which means that cash flow does play an important role. But when it comes to investing and trying to minimize opportunity costs, we need to be very clear what is our primary investment domain. So to repeat, when you're in the accumulation phase, your primary investment domain is capital growth. Now, if you're in the consolidation phase, your primary investment purpose or domain is cash flow. It's as simple as that. Now, it is important to mention that there are a lot of individuals out there who want to get onto the property ladder, but they need higher levels of cash flow or higher median rent for that asset in order to maintain that asset. And they also need future rental growth to be able to sustain that asset, i.e. pay off the mortgage, pay off all of the rates, and be able to actually keep the asset, not have a lot of pressure to actually sell it because they can't actually cover all of the cost of holding that asset. Now, those individuals might be inclined to invest in a balanced strategy, i.e. to invest in a town that has currently higher levels of yield and also higher levels of future rental increases as well. What is important to understand for those people is that if you're investing in a balanced strategy, you are inadvertently investing in an area that's going to go through different phases. Think about a seesaw. It goes up